Hello, everybody, and welcome to the Tortoise channel. If you are new here, welcome. And if you're not, thank you so much for all the support, guys. The number of subscribers has been picking up steam, which is fantastic. And I know many of our new viewers are from Portugal, so they are my breed. And it's nice to have you guys on board. Hopefully, you will find lots of value going forward. And the reason we are having so many people joining from Portugal is because I had the great privilege of being invited to a recent podcast hosted by Ricardo, and it's called Dividends Portugal. Of course, many of the viewers are from Portugal, right? Portuguese natives, and so it was awesome. Ricardo is very is a great guy, and he's putting out a lot of valuable information as well for his subscribers and viewers. And we did the recording about a month ago. It was jam packed with investment knowledge. We shared a few investment ideas, and hopefully you guys will be able to capitalize on those as well. So I'm very happy that you found it valuable based on the feedback that you've been providing. And I will make the video available on Wednesday, right? Because so far the video has only been published by Ricardo both on his Patreon channel and also on Spotify, but he hasn't posted it yet on YouTube. He will do so on Wednesday, and that's when I will be posting it and sharing it with my audience as well. So awesome. Fantastic, guys. Today we have a special video. I made this post for my community. We have by the way, guys, if you haven't joined our WhatsApp group, then consider doing so. We have a free WhatsApp in Skool community. And if you haven't joined yet, consider joining, because it's completely free. Right now on WhatsApp, this is where we are most active, of course. It's easy access, and we have about 47 members in that group and growing. And you can see that on Saturday, right, I messaged the group with the following. Over the last couple of days, I've been working on a new company research checklist that you can use every time you analyze a business. Until now, most checklists I've seen, including ones we've discussed before, were a bit too broad, right? They didn't really help you build a complete picture of a company through our 4Ms, meaning moat, management, and margin of safety. This new checklist is designed to fix exactly that. It's a structured, fillable form that forces you to connect all the dots, business quality, numbers, risks, and valuation in one place, instead of having research scattered across notes, spreadsheets, and bookmarks. And how many of us actually have faced that, right? I mean, many times I've had to juggle different, for example, stock analysis platforms. I still do, namely stock analysis and stock unlock, which are the one stock analysis tools that I use. But what happens is, because I didn't have until now comprehensive checklists that actually brought everything together, I would have to juggle spreadsheets, Word documents, stock analysis tools, right? It makes the process a lot daunting, and that is not what we want at all. And based on clients' feedback, then I decided to actually address that and create this checklist that I've been working tirelessly over the last 2 days, and finally I've managed to finish that. So because it took quite a bit of work, I will be sharing the full checklist directly with clients, where the expectation is that this becomes the standard tool you use when researching companies. That said, dear viewers, I don't want non-paying members to miss out entirely. I will also be creating a YouTube video, which is the one we are recording right now, walking through the checklist and explaining how I think about each section, so everyone here can still take ideas and apply the framework. So, with that said, let's discuss business, okay? And let me just go scroll all the way up right here. And now, bear with me over the last few minutes as I will delve deeper into each of the checklist sections. As always, if you find this video insightful, please smash the like button because it will really help the channel to grow. And we want to continue to create more value. And the more people that join, that means more value we are creating. And so it's a vicious cycle, right? Awesome. So yes, I will only make this available to clients. It took a lot of work. However, make notes. Make sure you are taking notes because a lot of what I've learned over time by investing in my own education, by taking online courses, by reading a ton of books, by subscribing to newsletters, it all comes down to a few concepts that I've managed to bring together, right, into just a few pages of a Word document, in PDF document. Okay, so number one, section one, we start with the basics. All right, company name, stock symbol, country, sector, industry, date of analysis, current share price, market capitalization. You will be able to get all this information, right? I'm talking directly to paying clients and unpaying clients, because I know that my paying clients, of course, watch every single video that I put out. And but non-paying clients as well, you can get all this information from the overview tab right here on stock analysis or any other stock analysis tool that you use. You can see the company's name, market cap. You can also see the sector, industry, number of employees, so on and forth. So all that first section details you should be able to find them there. All right. Section 2. This is where we start talking about quality assessment, everybody. Okay. This is important as well. And I want you again to pay attention to that. So let me go back. Okay, so let me just minimize this as well, right? Let's discuss this now. Right, section 2, quality assessment, meaning circle of competence and conviction. I see a lot of people making one thing, right? And correct me if I'm wrong in the comments, but I see people, when people talk about meaning, when I say people, I mean like-minded investors, they think, oh, can you understand how the company makes money? But before you even understand how the company makes money, the first question you should ask yourself is, am I interested in this company right now? If you are not interested in the company, you have no business understanding the company you have no business trying to understand how the company makes money in the first place. Yeah, so you should be able to you should be interested in the company, and you should be aligned with its mission and vision. Because one thing that I always preach about in this channel is we think as business owners, and because of that, I don't want any of my viewers to buy a company without thinking that they are buying it outright. Because we think as business owners. So the next time you invest in a company, let's say Amazon, make sure that you are approaching it through this lens. Will I buy Amazon outright today if I could? Right? Would you buy a company you are not interested in? Would you buy a company whose mission and vision you are not aligned with? The answer is absolutely not. And that's why these are the first questions you should answer, right? How does the company make money? That is the third question. Can you easily explain how Amazon makes money? Can you understand its business model? If you don't, then it's too complex. It goes right into too hard to understand pile, right? It's an easy pass. And once you do these things, everybody, what you will notice is that your universe of potential investments will narrow down substantially. And that is a very good thing. Do I understand the industry well enough to explain it to a 12-year-old? Can you break down the industry in which the company operates, right? You should be able to briefly detail that. Would I be comfortable investing 50% of my net worth in this business if forced to? Oh God, this will definitely force you to think as a business owner, right? And what it will do is that over your lifetime as an investor, you will only own a few handful of companies if you think this way, all right? Because and that's why, just to give you an example, every single company in the Like a Tortoise investment portfolio checks out every single one of these boxes. So before we put money into those companies, let's take PayPal, yes, because it's also in the portfolio. We ask this question: will I put 50% of my money into that company? And if the answer is no, then it doesn't have a strong enough meaning for me. All right? And because I like to understand the companies that I own very well, it's an easy pass. Why? So, what problem does this company solve better than alternatives? You should be able to tell that as well. That's why it's right here for everybody to see. How do customers really feel about this product or service? Are they happy with their services? And you can see, you can look that up on Google as well, right? You can check out customer reviews. There are a lot of information where a lot of sources where you can get that information from. And so two sites where I like to collect this information from include Comparably, right? And also Glassdoor, both of which are entirely free. All right. So every single investment case of mine includes, for example, things like customer reviews, the rating of the company and culture, and all of these things. This is all meaning, right? Now, over the next 10 years, I expect this industry to grow, stay the same, or shrink. And why? Why do I mean by that? And why do I have industry right here? Because I only invest in companies that operate in a strong secular market. Is the market expected to grow into the next 10, 20 years? If the answer is no, if it's in a declining market, then I don't invest in it. Think about things like AI, obesity, online payments, online gaming. All these things are secular markets, and they are expected to grow at double digits over time. This is the kind of stuff that I want that I want to see in an industry, right? Awesome. So meaning this all culminate in where can you find that information from? Guys, today with AI, you can look that up. You can say, for example, you can start by, for example, for PayPal, ask Google, hey, does PayPal operate in a secular trend, right? In a strong secular trend? Why? Okay, look up different investment cases on PayPal and you will be able to determine that information. Again, a lot of that is free. And if you are working with me, you already should know the sources from which you should collect that information from, right? Okay, so meaning score 1 to 10. This all culminates in a score, a total meaning score, with 10 being exceptional, clarity plus deep conviction. The higher, the better. Now we delve deeper into moat, durability, and economics. The type of competitive advantage. Tick all that apply. I talk about moats and competitive advantages, which are the same at length on the channel. But it's important for us to understand what type of moat does the company enjoy. Is it a cost advantage type of moat, switching cost, network effect, intangible assets, or efficient scale, or a blend of both? Or a mix of several of them. Cost advantage is, does the company, for example, is the lowest cost operator in its industry? Think about companies like Costco or Walmart, right? They can charge very low prices for what they sell because they have this cost advantage, right? That is a moat, especially if it's lower prices than all of its competitors, right? Switching costs. Think about companies like Apple. When I ask people, hey, do you have an Apple phone? Would you swap that out for a Samsung? Most of them tell me no. That is switching costs. Apple they lock them into their ecosystem, right? It creates stickiness with customers and that creates high switching costs. What about network effects? Think about Meta, Facebook. They have Instagram, they have Threads, they have WhatsApp, they have Facebook. Is it difficult for people to switch from Facebook into another provider? Of course it is, especially for business owners. Think about business owners that have set up their businesses on WhatsApp and they are monetizing it. Do you think it will be hard for them to actually a switch to another provider? The answer is yes. So Facebook boosts both switching costs and network effects. Network effects is because the more customers use Facebook and WhatsApp and so forth, the more companies will be able to set up their businesses with these platforms, right? Because they have access to a ton of people, which is pretty cool. So if intangible assets, think about Oracle, the databases. This is all intangible assets. Think about intellectual property. Like one company in our portfolio, Evolution AB, they have games, right? They have a lot of intellectual property. A lot of the assets is tied into intangibles. Regulations, licenses. Think about companies like Novo Nordisk. Many of my clients invested in Novo Nordisk, and they have they have patents, they have trademarks. All of that create a competitive advantage. And by the way, some of you asked me, why didn't I invest in Novo Nordisk if I talked about the company, if I boasted about the company, right, and the fact that many clients invested in the company, whereas I decided to pass up on that opportunity. The reason is because I don't like the industry. Yeah, I find it boring. I don't like it because I find it boring. If I'm not interested in the company or industry, then I'm not investing in the company, no matter how great the fundamentals are, right? That's why. Here's your answer. So let's continue, and then you should be able to determine why is the moat durable, what specifically prevents competitors from copying or attacking it. This is all very important, right? Again, you can look this up on Google as well by researching investment cases on companies, and all of this is entirely free, and it's something that you can easily access to. Okay, if you have the time for it, of course. But everything that I do, guys, and if you are watching the channel for the first time, this is going to be important. Over time, I've built my framework for busy professionals that generate high income, but they don't really have time to achieve the kind of returns that we do. But they don't have time to, for example, to follow other investment strategies that literally require them to devote a lot of time to their investments. So over time, I tailored our framework to busy professionals, and what it takes is literally 1 hour of your time per week. So the question that I'm asking you, that I ask you, and every single person who works with me is: A, do you think doubling money every 3 to 4 years is worth an hour of your time per week? If the answer is yes, this framework allows you to do that, because most of the time you do nothing. You buy a few handful of great companies, you sit on your ass and wait, and that is the beauty of this framework. Okay, awesome. So growth, quality, historical averages populate the table. Over the years, the most successful investors always look at the same metrics, and they include revenue per share growth, operating cash flow per share growth, and earnings per share growth. I want to see all these metrics growing at 10% or above over a 10, 5-year, and 3-year average. And if that is not the case, you have to understand why that happens. Why do I have operating cash flow instead of free cash flow? Think about companies that have low free cash flows, because they are doing a lot of reinvestments, like Amazon. If you do free cash flow per share growth, you will be punishing a company that is reinvesting all the time into growth, right? And that is that is unfair, because these companies can still be phenomenal compounders. And Amazon, for sure, has been a phenomenal investment over the last 20 years. So I use operating cash flow per share growth, okay? And then what you're going to do is the average of the average growth, and you will fill out this box right here, okay? Just take out the average and just so the average of revenue, operating cash flow, and earnings per share growth. So, and this is the overall average that you should populate right here. Consistency of growth, is it smooth or volatile? Guys, this is so important. Why do I have this here? Because I don't like to invest in highly cyclical companies. So companies, for example, whose earnings are tied to the performance of commodities are an easy pass because their earnings are volatile. Volatility creates unpredictability. Unpredictability means inconsistency in the earnings going forward, which doesn't make for a good investment. I want to see ideally all these metrics growing consistently over time, right? I want to see smooth growth as opposed to exponential growth, because what happens is exponential growth will attract a lot of competition. But if a company is growing all these metrics at 15, 20, 10% per year, I'm okay with that. I'm happy with that, and so should you. Capital discipline, capital and cash discipline, debt and free cash flow. This is important. I want the debt to free cash flow to be under 3, which means that the company can cover all of its debt within 3 years of current free cash flows. Now, if the company is like an Amazon that reinvests everything into growth, then the free cash flow is not a good denominator, is it? In that case, what you will do is you will replace free cash flow with net income, and it should be below 3 too. So the company should be able to pay down all of its debt within 3 years of current earnings, net income, right? Is the debt increasing, decreasing, or stable over time? Ideally, the debt should be decreasing over time. If it is increasing, make sure that the revenue and profitability of the company is growing at a faster pace than revenue. Than debt. Okay? Cash conversion ratio. I want to see a high cash conversion ratio. I want companies that have high quality earnings, and these are companies that translate almost all of their earnings into cash flows. Every single one of my investments has a cash conversion ratio above 100%, right? And this means that they convert most of their earnings into cash flows. This is important. Operating margin, net margin. Margins are what, everybody? A percentage of revenue. Ideally, I want to see expanding margins over time, not shrinking margins. Many of you asked me, yeah, but PayPal's margins have declined. Yes, but that was over the last 10 years. When I invested in PayPal, I invested in the company because number one, the CEO was new. I didn't like former management, and the new CEO took over in 2023. I bought the company in 2024, and the margins under the new CEO were improving. And sure enough, if I show you this right here, if I show you this PayPal, you can see financials trailing 12 months. You can see gross margin was increasing at the end of since 2023. Let me change this to the yearly. Look, growth margin was increasing. You see, operating margin was exploding. Profit margin was also going up, as you can see. That's why I invested. So expanding margins are one of the first signs of a turnaround. Very, very important. And where can you collect all of the other data, everybody? The debt free cash flow, is debt increasing? So the metrics, revenue per share growth, I personally extract that from stock analysis, from stock and lock. And I paid for that about £9 per month. And because the free tools will only give you access, say, to 3 years or 5 years worth of data. But for 10 years worth of data, you need to pay most of the time. Or maybe if you look that up, go to Google and say, PayPal's revenue per share growth over the last 10 years. And you type that in, and you should be able to see something, right? That is the numbers you will populate right here. Where can you find all the other information? Royce, the same thing with Royce, the debt to free cash flow, all of that you can get for free in the statistics tab within stock analysis. Look at that. You can see, look, financial position, right? Debt to free cash flow, right here. financial efficiency, returns on invested capital, returns on equity, all of that. Look at margins, everybody. Operating margin, gross margin, right? Net margin, all of that is right here. The cash, this one is not. This one is not. The capex relative to operating cash flow is not, and it's in the sheet that I make available only to clients as well. And how do you do that is very simple. Let me show you. Look at that, right? Cash conversion ratio. I do the operating cash flow divided by net income. In this case, this is for Microsoft. You can see again, it's above 100%, which means that the company converts a lot of net income into operating cash flows. This is a sign of efficiency as well, and this is what I want. Okay, so the debt to free cash flow ratios are right here as well. What else was I saying? So we discussed margins. So how do you do the cash conversion ratio? You can just do the free cash flow divided by net income. Yeah, and that's it. Okay, so how do you do the capex divided by operating cash flow, and how do I do that? How do I do that information? You do that by dividing the total capex, which excuse me, let's go back right here to PayPal. If I go here to financials, cash flows, change this to trailing 12 months, and then what you will see is you will have capex, right? Capex is about 852. So is this the number that you should take? The answer is no, because let me explain. There is maintenance capex and there is growth capex. Maintenance capex is the capex, the investments that the company needs to make to maintain its current operations, right? This is the number, the portion of total capex we want to isolate, right? And then we have growth capex, which is the money that the company uses to buy new plants, property, equipment, to invest in data centers, right? In the case of Microsoft, for example, or any other of the Magnificent Seven, most of them. So the number that I want you to take is only the maintenance capex, and you can see if you don't, typically you will find it on the annual report. If you don't find it, you can use the depreciation and amortization line right here on the cash flow statement as a proxy. And that is the number that you will use. So then you will divide that by the operating cash flow, and you will get the capex, so the maintenance capex relative to operating cash flow. And ideally, ladies and gentlemen, I want that to be under 15%. Okay? If it's under 15%, that's awesome. What's happening right now with many companies, for example, Microsoft, is that this number has been exploding, right? Even when you strip out the maintenance capex, when you strip out the maintenance capex, you can see. Let me go back here to the sheet, my sheet right here. You can see that maintenance capex as a percentage of operating cash flow is still above 20%. So these companies that used to be low capex are now high capex, but the valuation multiple has not come down enough to reflect that change. Okay, so this is why I don't want to invest in high capex companies. And you can see in the case of Microsoft that maintenance capex, or depreciation and amortization, has been exploding since 2023. And you can see why the total capex right here has been exploding too, as a result of the investments in data centers for AI, GPUs, and so on and forth. Okay, so this is important, everyone. Awesome. Now, another thing that I want to emphasize, stock-based compensation as a percentage of net income. To have access to that information, you can come here to the financials and KPIs, right? Metrics right here, and you can see stock-based compensation as a percentage of operating cash flow. I want this to be under 10%, which means that the company is not diluting existing shareholders by doing a lot of stock-based compensation, right, and issuing new shares. So as a rule of thumb, I want stock-based compensation as a percentage of operating cash flow to be under 10%, right? Under 10. Awesome. And right, what worries me, if anything, about capital allocation? And you should be able to write a few sentences on that. I hope this was clear, everybody. And then competitive landscape, top 3 competitors. What are the main competitors of Microsoft? I want to see the names, why they matter, and why they don't disrupt this company. So Microsoft, why will they not disrupt Microsoft over the next 5 or 10 years? I want you guys to be able to tell me that, okay? And then this all translates into a final mode score of 1 to 10, being 10 highly defensible economics with long runway. Last, we have management. Well, it's not last, it's the third section, management, people, and incentives, right? And this is important because we want to be very cautious about who we are trusting our hard-earned money with. All right? And so management and people incentives, as Charlie Munger once said, show me the incentives and I will show you the outcome. So ideally, I want to invest my money with a CEO who has been at the helm of that of the CEO seat for several years, right? And so write the name of the CEO and how long he's been a CEO for. Same thing with the CFO. And then I want to see the insider ownership. And by the way, if the CEO hasn't been with the company for that long, if the CEO hasn't been the CEO of the company for that long, that is okay. Just make sure that he has a very good track record of excellent execution, right? Check out his track record. His or her track record. Have they done very well for the shareholders? And hopefully they will have worked with the company for several years and they climbed up the ranks. Yeah, but if they joined from another company, that's fine. Just check out their records. What have they done in the past? Have the companies they were working at delivered outstanding results for their shareholders? Make sure you understand that, okay? Insider ownership, I want it to be high because ideally you want to invest in managers that have a lot of their wealth tied into the business, skin in the game. Most of the companies in the Leica Tortoise portfolio have a lot of skin in the game, insider ownership. So, for example, I've been giving you the example of Microsoft, right? If I go to Insider tab right here on Stock Analysis, where I get this information from, if I go to the ownership tab, show only company executives, take a look at this. Nadella is the current CEO and chairman of the board of Microsoft, almost $500 million worth of stock. Look at the CFO, almost $200 million worth of stock. And and the same goes for many of the other executives. This means you have a lot of skin in the game. So our interests are aligned, and this is exactly what I want to see, right? So let's crack on. And now we have, track record. Metric, Royce and Roy. And Royce is arguably the most important metric of all. It shows us the return on invested capital. In other words, how good is management, right, at converting invested capital in the company's operations, right, into net operating profits. No PAT, so net operating profits after tax. This is what we want. And ideally, we want to see an expanding ROIC over time, which means the company is becoming more efficient, right, at converting invested capital into profits. And that's why I pay a lot of attention to ROIC, because think about, even if a company, for example, takes on debt, and that debt doesn't immediately, if the company is taking on debt, and it's not generating profits with that debt, then that will show up in a declining ROIC, right? And that's not what you want. So ideally, you want to see an increasing ROIC over time, as I already mentioned. Okay, same thing with ROI, return on equity or shareholder equity, and that's why I have the trends right here. Royce, trend is increasing, stable, or declining. Be aware if the trend is decreasing. So, for example, let me show you something, guys. A struggling company, as many of you will call it, for example, PayPal, which is also a very good example of that, a very good example in this case. Why did I invest in PayPal? Because PayPal's return on invested capital are improving ever since Chris took over. So if I go here to the ratios, right, look at that. Royce, ever since Alex Chris took over at the end of 23, Royce is going up, right? Look at Roy, is going up. Look at Ross, is going up. So the company is becoming more efficient, and this is exactly what you want as well in a turnaround. Okay, I don't just do turnarounds, by the way. But what happens is when a company crashes 60 or 50%, which is typically the point at which I become interested in the company, it usually becomes a turnaround company. All right, let's continue. Integrity and trust is everything for me. And if you guys, many of you guys are already working for me as have become clients over the last few months and weeks, you know how important both these things are for me. Does it make sense that I also want to invest my money with people who are genuine, transparent about their processes? Yes, it does, right? So I want you guys to be able to answer these questions. Has management demonstrated integrity in the past? Give an example. Would I trust this management team with my retirement money? Why and why not? What this will do is it will force you to listen to the last conference calls, right? If they mentioned something 4 or 5 quarters ago and they are now saying a complete different thing, that is a red flag. You actually want to see them saying something and then delivering on what they promised. All right? That is very good. For example, a management team that puts out low guidance and consistently beats on that guidance, I like that. But a management team who only puts out very bullish guidance, optimistic guidance, and then fails, right? Fails to live up to those expectations they themselves set, that's a red flag. So what's the CEO approval rating on Comparably? This is so cool. How can you get that? Go to Comparably. Take a look at this. Go to Comparably. For example, Microsoft, right? We were doing Microsoft. What's this? Microsoft Comparably. Microsoft culture. You just click on here. This is entirely free, by the way. Boom. CEO Satya Nadella, 83% score out of 100. Look at his approval rating. This is staggering. 83% employee reviews of Microsoft's employee reviews were positive. This is a high approval rating. This is what I mean. And this is what I always factor into my investment cases. Okay, awesome. Does the company have positive reviews from employees? Again, that's where you would collect that information from. And this terminates into a total management score 1 to 10, with 10 being owner-operators with strong capital discipline. This is what we love, right? And now, margin of safety is the last, is the last M. And what is the intrinsic value of the company? And if you are working with me, you should know exactly how to use the discounted cash flow method to determine the intrinsic value of a company. Okay, and I even have a template that I share for free that you can download in the comment section. Key DCF assumptions. I want you guys to type in your growth assumptions going forward, your perpetuity growth rate, which is typically around 2.53%. Notice how I didn't change the desired return. It's always 15%. At Like a Tortoise, we want 15% of our money over time, which means we are doubling money every 4 to 5 years. All right. Then doing the reverse DCF, what is the current implied growth in the stock price? And you should be able to type that in here. And then what you are going to determine is if the current expectations built into the stock price make sense to you or not. Multiple comparison. The P, what is the P of the company over the last 10 years, 5 years in current PE? Same thing with the price to free cash flow. You can get all of that information for free in the statistics tab on stock analysis right here, valuation ratios, price to free cash flow and the PE ratio. This is the current, the 10 years and 5 years numbers. You will probably need to subscribe to a platform, or you can just type that in Google. What is PayPal's 10-year average PE ratio? And that should come up with a number, right? Cool. Make sure you double check that information to see if it's accurate, right? To make sure there is no, it doesn't give you like a random number that is false. Okay, so is the stock trading below, based on this analysis right here, that I kept it simple. So I didn't put here the Phil Town's valuation methods, margin of safety, payback time, and the 10 cap rate, which I discuss at length in other YouTube videos. And if you guys are working with me, you know that I always use these methods as well whenever I'm doing an analysis. But I wanted to keep it simple, right? And not least because what I found is that if you use a desired return of 15%, the margin of safety that you will get from the DCF is similar to the numbers you will get from the other three methods used by Phil Town. Okay, not always, but typically that is the case. I kept it simple, not least because I'm adding other multiple comparisons right here to shore up the case, right? Okay, so is it cheap, in line, or above norms? What's the initial buy price? Is this company currently on sale? Yes or no, and why? And then margin of safety, last score 1 to 10, with 10 being a wide gap between price and value. And then we now have section 3 right here, long-term thinking. I want you guys to tell me 3 reasons to own the stock for the next 10 years. You should be able to determine those 3 reasons. This is going to be very important, okay? And then stress tests. If the stock fell 40%, what is the most likely reason? That is one question. Would this issue be realistically be resolved within 3 years? Because this is important. One of the things that I discuss with clients at length, but also here in the channel, is I like, and you guys know this, right? I like to invest in companies that are down 50, 60%. But not every company. The issue should be realistically resolved within 3 years. How will that happen? This will happen if it's not a structural issue. If it's a structural problem, it can take several years before the company actually turns around. All right? And so ideally, it should be resolved within 3 years. Right? So this is important. And if the stock does crash 40, 50%, and let's say you are down 10% on your position, when will you sell? Will you sell? Right? So if the story changes, then you should sell, right? You should be able to note that down as well. You are stress testing your investment thesis here. Story inversion, right? Top 3 things that could go wrong over the next 10 years. Note them down. Rebuttals. Top 3 rebuttals to the above risks. In other words, what does that mean? Charlie Munger once said, if you ever want to find a solution to a difficult problem, inverse it. In other words, turn the problem upside down. And this is what the rebuttals and the inversion exercise is meant to do. 3 things that can go wrong. For example, PayPal's new CEO, Enrique Lores, right, is not going to be able to turn around the company in the next 2 to 3 years. That's something that can go wrong. How would you reboot that? Well, he's going to have high insider ownership, right? In fact, his interests are closely aligned with those of shareholders, because if he gets the stock price above 130, you will unlock millions of dollars worth of stock. Okay, so he's heavily incentivized to actually do that in a period of 3 to 5 years. You see? So you find the problem and then you identify a solution to that problem. Okay, and you should be okay with that. Section 4, final decision, conclusion, select one. Is this a buy, a watch? Go to the watch list, too hard pile, not wonderful, and you explain why. That's it, guys. So this was a very comprehensive video that I shared, and I already shared this checklist with clients. For those of you who are not clients and are just watching this, I hope you've managed to find a ton of value, because this, if you manage to use something like this for your investments, I think you will be well on your way to making sound investment decisions going forward. Okay, and guys, before I forget, I go here to my YouTube channel. Okay, don't forget that we have our weekly group call, free, which we do every single month right here on the 27th of February. Ask me anything. The last one was awesome. 25 people joined, but our group on YouTube is growing every single day. Make sure that new members that are watching this to join. Ask me anything. Let me get to know you. Let's exchange ideas and let's be productive and profitable in the years ahead as well. Okay. So that's it, guys. I hope you managed to enjoy this video. If so, let me know in the comments below if you derive value from it. That will make my day. Thank you so much for your ongoing contribution, and I'll speak to you guys very soon. Be a tortoise.